Chapter 2. Now we are going to look at the costs. The building blocks of managerial accounting basically is costs. How do we allocate the costs? Costs is very important, and we need to know this. So we have most of the chapters are going to talk about in this semester is about the costs. Okay, so let's look at some basics. The first objective here is to distinguish between merchandising, and the manufacturing companies. There are three types of companies in the world, and we are actually moving to a service economy. And merchandising is for the sales, like Walmart, Staples, Kohl's, SafeMart, and so on. Manufacturing companies things are made in these companies, like car makers, automobile companies, GM, Ford, Toyota, and so on. Or some other companies who make like lamps, beds, mirrors, chairs, TVs, and so on. So those are the manufacturers. Those are manufacturing companies. So these are the three different companies we just talked about. And a service company provides service only, like accounting firms, law firms, consulting firms, and they do not carry any inventory. Inventories are those things they use for sale. So they do not sell stuff, they sell their services. So advertising agencies, bank, law firms, insurance companies, accounting firms, and many of these companies nowadays. You can see everywhere. When you go out, most of companies see all the service companies actually surrounding you. Merchandisers, go to the malls, go to the stores. They resell products purchased from suppliers. They do not make things. They only buy low, sell high. They have one inventory account. For example, Walmart, Best Buy, Amazon, Dell.com, and so on. Retailers and wholesalers, there are two different types of merchandisers. They are different, and they are all on the value chain. That's something we're going to talk about later. Manufacturers, they use labor and other inputs to convert raw materials into finished products. So where do we get cars? Cars are from the raw materials, steels, and they make parts, put parts together, and we get the cars. P&G, for example, they are beauty products, health products, and so on. General Mills, cereals, for example, many of us eat from General Mills and other companies. Dell Computers, they produce computers and servers and other computer products. They're using three inventory accounts. So we're going to talk about this in the next slides. Raw material accounts, that's something they purchase so that they can produce, they process these raw materials and make them into parts and reassemble the parts. And when the parts are resembling, before they become the final products, they're called work in process. And when they're done, ready for sale, it's a finished goods. The companies keep these three accounts. Second objective is to describe the value chain and its elements. Value chain is the activities that add value to products and services and cost money. So basically, when we buy something in the store, they come from the raw material, and after each step, more cost has been added to it, and more money you need to pay for it. So the value chain starts from they have different components: research and development, and it's called R&D, and people, for example, drug companies. So how much is a drug? It's a pill. It costs you $5, $10, $50, even $500 a piece. Why? Because most of the money you pay for are paid for the research development. Because for the drug companies, they're paying millions and billions of dollars to do the research on the drug itself. So they have to allocate this cost into the sales so that they can get money back, so that they're not going to lose money, so they can reuse the money to produce more medicine for us. Design, of course, drug companies do not use design here, but for the car companies or the other products we're using here, design is also a big amount of money companies are paying. So to the people who do the design, and then consumers are paying for this, and this part, the money paid for this design is the costs add into a value added into the product. Production or purchases. Production for manufacturers. So production costs, there'll be costs to produce things, right? And you need to pay people to make it. You need to pay the money for the materials. You need to pay the money for the facilities, like buildings, like the equipments, machinery, and so on. And purchases, of course, you need to pay. So if you're selling your retail store, you sell lamps. So you have to pay in advance, say $20 to pay for the lamp. You sell for $40. Okay, that's the purchases you need to pay in advance. Marketing, you want to sell something, you need to let people know we're selling this. So you need to pay for the advertisement. You need to pay for the salespeople, and so on. Those are marketing. Distribution, and also especially for current economy now, and people need to use this distribution network to sell stuff, so they pay to the distribution channels. Okay, and customer services, it's a cost companies have to prepare, so that when customer says return or repair or whatever issues they have, or warranty, and customer service need to take care of those. So those will be part of the value chain. So let's look at the on the book, that's E2-18A. Let's say exercise. We classify each cost to which category of the value chain it belongs to. Is R&D, design, purchases, marketing, distribution, or customer service. So newspaper advertisement, of course, is marketing, because you do advertisement so that people will know that you're selling this at a certain price, and that's so attractive people to come to buy from you. Payment to consultants to advise in allocation of new stores. Okay, this is R&D. So you pay to those consultants for advice. So they do some research, so you need to pay for the research. So this is R&D. Purchase. Okay, next one, of course, is purchase. Purchases of merchandise. Freighting is also part of our purchases, because when you buy something, you need to pay for the shipment. Okay. Salespeople's salary is marketing, as we said earlier, and people sell stuff, so it's in marketing. Depreciation expenses in direct trucks, and so you move things around, and the expenses paid for. It's a distribution. Next one, research on R&D, of course. Research on whether store should sell satellite radio services or not. Customer complaint department, service. It's a customer services. Rearrange a store layout is design. So you need to design your store, how we can reallocate different products in different places, or how you're going to make different shelves and so on. So those are the design. Next, objective, to distinguish between direct and indirect costs. This part is pretty important, because we're going to deal with this very, very often in the semester. So mostly we're going to deal with these direct costs. Okay, costs are anything for which managers want to separate measurement of cost. So it's objects. A cost object may be a car you're making, or a computer making. Those are called a cost object. Cost object. So anything managers want to say, okay, for this lamp, or we're making lamps, how much does it cost to on this lamp? And so need to allocate those costs. So there are two. direct cost and indirect cost. So let's take a look at the, we probably want to explain what the direct costs and indirect costs are. And the direct costs are basically anything that you can, it'll be directly related to the cost object, object, yes. So it'll be it's directly distributable to the object, the cost of materials, labor, equipment, and so on. They're all directly are involved in efforts or expenses for cost objects to be made. They are direct costs. And indirect costs are some examples of direct costs, like project staff, consultants, project supplies, publications, travel, labor, direct materials, electricity. Only those electricity is a principal source, but most cases electricity may be considered as the indirect cost, and clothes, for example. So those are something you can directly associate to the cost object. And indirect costs are not so many. They are overheads, administration costs, for example, pay to the managers, pay to the CEOs, electricity and other utilities that cannot be easily allocated. Okay, we'll make this lamp. How much electricity does it cost? Okay, it may not be. It can be sometimes allocated, but if it's electricity paid for the office building, okay, how do we allocate this cost? So this can be considered as indirect cost. Or selling and distribution costs may also be considered as the indirect cost. So let's take a look at these ones. It's direct or indirect. Depreciation of building. Okay. It's indirect because why? It is not directly linked to the product you are making. It's the building itself. So cost of costume, jewelry on the mannequins in the junior department, of course, is a direct cost. And cost of bags used to package customers' purchases at their main register for the store. It's an indirect cost. Why? Because a bag may be used to put in one or maybe put into 5 different products, and you cannot allocate directly this cost into the single product. So they be considered indirect cost. And the Benita Coast store manager's salary, of course, salaries are indirect cost, as we said before. Cost of a security staff is indirect cost. What's going on here? So let's get back. Let's get back here. The managers of junior departments, and here, this is different from the store manager's salary. Store managers are the administrative, and managers of junior departments, one of departments, and this is a line manager. They are part of the operations. So we consider this as a direct cost, and it will be directly contributed to the cost in this department, and it can be allocated directly into the products in the department. So we consider this as direct cost. And juniors, department sales clerk, and then it's different from security staff. These clerks are directly associated with juniors department, and they are also part of line guys who are contributing to the cost can be allocated. So this also can be considered as direct cost. Cost of juniors clothing, of course, that's products we have here as a direct cost. And cost of the hangers used to display the clothing in the store is the indirect, so it can be reused, and it can be reused for a period of time, and you are not going to make this as something can be allocated to a specific kind of they go over multiple periods, for example, and it cannot be allocated directly into one of those period or one of the products. So, this one goes directly answer here. Electricity for the building is indirect. Cost of the radio advertisement is indirect. Unit clothing buyer's salary. Those buyers buy for all of the units department for the of the cost store is indirect cost. So next objective is to identify the inventoriable product costs and period costs for merchandising and manufacturing firms. So this is kind of interesting, and there are two very different type of costs. Inventoriable product costs are something you're going to give out to the outside. For example, when you're preparing your income statement, and you need to report, your inventoriable product costs. But period costs are something you're going to use to identify for current for within a period of time. For example, mostly you use a period of time. Period cost will be the depreciation. So the cost will not be allocated within on one specific product and you're selling, and it'll be something you're going to allocate throughout a certain time. For example, most of the month or half year or 3 months or even a year, and you can allocate those costs. So we're going to take some examples in the next slides. So we're going to have to define some of the product costs. So once the total cost is used to internally only, it's internal use only, and so we're going to see something later in the chapters following. And inventoriable costs, product costs used for external reporting. So we're going to see in here. Total cost in here is okay. In 2004, there was a certain total cost. It includes two parts: inventoriable and period costs. And inventoriable costs of production or purchases initially recorded as inventory. And period costs will be R&D, design. This is the depreciation, but we'll see that depreciation later. Marketing, distribution, and so on. It did not allocate costs within for per day, for example, or per product, and it allocated within certain period of time. And so for the inventoriable products, on this side we have learned in the financial accounting. So inventory sold in 2014, and in 2014 income statement appear as a cost of goods sold. Inventory not sold until 2015, it will be considered as a balance sheet in 2014 as inventory, and in 2015 when they're sold, it becomes cost of goods sold for that year. And for the period cost in our income statement, it becomes operating expenses. Okay, those are cost of goods sold, the expenses. They are all negative in income statement. For example, on the top, you're going to have revenues. You're going to take the cost of goods sold. Then you're going to have a gross profit, and I'll take out all the expenses, operating expenses, and other expenses, including tax and interest and so on. And then to the bottom line, you're going to have that income. So those are how the costs will be reported in the income statement. So for the merchandiser, inventory product cost will be purchase price from the suppliers, and for merchandiser, you're selling things, you're not making things. You're going to only purchase. And then you're going to have a cost to make them ready for sale, including the shipping. You're going to move something from one place to another, and also you need to go to shelving and so on. There'll be cost directly allocated. And then freighting's here, the shipping here. Input duties or tariffs. If you get something from outside of this country, you're going to pay for the duties and the tariffs. And then put together will be total inventoriable product costs. So for the manufacturers, there will be direct materials, and raw materials, and or maybe some parts of direct purchase. Direct labors, there'll be direct costs, and we are going to have manufacturing overhead as indirect costs. So, of course, for the direct costs, we have a lot more than this. In the later chapters, we're going to cover. And the indirect costs, we have a lot more than this. We're going to see what will be considered as indirect costs, what will be considered direct costs. But main idea here is the direct costs will be directly allocated into the product as a cost. And indirect costs, you need to do some calculation so that you can allocate those into the product cost. Manufacturing overhead, a little bit more on this. Indirect costs relate to manufacturing that are not direct materials or direct labor. Indirect materials. What are the indirect materials? For example, you need to prepare the paperwork. So what about those paper? You need to buy those paper. So this will be indirect materials. The paper for printing the reports or anything will be documents travel through within the processing, and there will be indirect materials. Indirect labors are the supporting people, and you pay for example, cleaning people or other people who are not directly on the production line. There'll be indirect labors. Other indirect manufacturing costs. We didn't mention here, so overhead can also be the managers who are not directly on the production line. They'll also be considered as indirect cost. So here's another example. We are going to take a look at the pure cost or inventoriable cost. And if they are inventoriable cost, are they direct material, direct labor, or manufacturing overhead? Okay, so here is the exercise, and I just walk it away and I can come back, and so I have to restart. So we're going to look at whether we have pure cost or inventoriable product cost. Inventoriable product costs are something you can directly allocate into the product itself, and pure costs are not a necessary part of the manufacturing process. So as a result, it cannot be assigned to the product or to the cost of inventory. So let's take a look. Cost of materials purchased from local dairy farms. So of course it's direct cost here, and also direct cost is it's inventoriable, and so it's a direct material you're going to use to make cheese or something. Okay. Depreciation of marketing departments, computers, and the pure cost, because pure costs are usually associated with selling functions of the business or its general administration. So this sales department, marketing department, this is from sales, so the period. Property tax on dairy processing agent plant. So plant is somewhere it can be used to make dairy products. So it'll be directly related to your product. So it's a product, and but it's not direct material, because it's not material. It's not direct labor. Of course, it's manufacturing overhead. Gasoline is used to operate refrigerated trucks delivering finished dairy products to grocery stores. So this is associated with sellings and the sales department. So when the sales department, we consider as a period. So it'll be a period. It's pretty easy. Companies, president's annual bonus. Okay, no matter how much they pay, usually it's a pretty big amount, but this will not be directly associated to the product, so it'll be period. Depreciation on the refrigerated trucks used to collect the raw material from the local dairy farms is linked to the first one, and so it's for the manufacturing processes. It's not for sales, and it will be product. So depreciation on this one will be product. and this will be manufacturing overhead because it's not a material, this is not labor, and it will be manufacturing overhead. Plastic gallon containers in which milk is packaged. So it'll be product, of course, it's part of product you're selling, and so it's with product. And this is a direct material. And research and development on improving milk pasteurization processes is R&D. It's kind of a period, so it's not a product. But really, it really depends on the industry. If it gets to the pharmaceutical industry, it's possible they can link this to the product directly because it's very, very important part of the cost. But still, it's not a product; it's just a period. And but it'd be an indirect cost to directly allocate into the product. That's some special cases. And so television advertisement, of course, is a sales related, it's a period. And lubricants used to run bottling machines. So it's on the maintenance of a machine to make product to be, of course, a product. So it's not direct labor, it's not direct material, it's manufacturing overhead. Wages and salaries paid to machine operators at dairy processing plant. Those are the people on the line. The payment to them will be directly linked to the product itself. This will be a product, so it will be a direct labor. Okay, so these are basically exercises. Make sure you understand what we are talking about here. And next, we are going to talk about prime and conversion costs. Just some idea. Prime cost equals to direct material and direct labor. It's only a definition. So prime cost is the total of direct material and the direct labor. And conversion costs are those manufacturing overhead plus direct labor, but not direct materials. So put all these together. These two together is called conversion costs. But you are putting the direct materials and direct labor will be called the prime costs. Direct and indirect labor costs include. So labor costs can also be direct and indirect. Remember, we have even managers. Store managers are not line managers. The managers in the departments will be line managers. So one is direct, one is indirect. So sales and wages. And so those are labor costs basically. Sales and wages. Fringe benefits. Fringe benefits are not something you paid in cash, but according to the IRS, IRS have some definition. A fringe benefit is a form of a pay for the performance of services. There are some examples. You may provide an employee with a fringe benefit when you allow the employees to use a business vehicle to commute to and from work, and a performance services. For example, a person who performs services for you does not have to be your employee. So those are, but you can provide fringe benefits to people without paying them. But this is our IRS definition. That basically, when people receive these fringe benefits, they have to pay tax on those as part of their income, actually. Payroll taxes, and those are the labor costs, and you're paying. Companies pay for the payroll taxes, and when we get to the payroll part, and you should have learned payrolls in the 2110 financial accounting, and the payroll includes companies need to pay for the unemployment insurance, and for example, and they need to match their Social Security, for example, and those are the payments have been paid. That's called the payroll taxes. Next objective is to prepare financial statements for service merchandising and manufacturing companies. So we're going to do this part very fast because we have learned financial statements, but they are kind of different. And here, income statement for service companies as a simplest income statement. So all costs are period costs. So there's no inventory costs because they do not have inventory. So all service period cost, cost of period cost. So service revenue minus operating expenses will be operating income. And for the merchandiser, and they have inventory, so but they have only one inventory, so it'd be pretty simple too. Sales minus cost of goods sold, and equals to gross profit minus all the expenses, will be net income. So or operating income, so before the tax, before tax and interest. So if the probably interest already put into no, it shouldn't be any operating expenses. So operating income minus even interest and taxes, and there will be net income. And for the let's see, it's merchandiser. What our cost? How do we calculate cost of goods sold? I believe you have also learned this, and it will be you need to use beginning inventory plus purchases minus the end inventory, and you're going to minus something else. Of course, something you have to pay for the import duties and tariff from outside, and you're going to add the freight and the shipment you have paid for, and the cost of goods available for sale, and to take off the end inventory, ending inventory becomes the cost of goods sold. So this is kind of a calculation of a cost of goods sold. So if you have any problem with this, and my suggestion is to go back to your financial accounting book. It has a pretty clear definition on how to do calculation. But if I remember correctly, I just taught financial accounting in last semester. So import duties or tariffs, mainly in the financial accounting, may not have mentioned this. But it's also part of the, especially now companies are purchasing the products from the Asian countries or Latin American countries, so I need to pay for the duties and tariffs government are charging you. So this can also be part of the cost added to the goods for sale. The book has some examples, so I'm not going to go through this, and we'll just skip through all this quickly because it's so easy to understand. And the direct materials used to calculate the calculation of the direct materials, and it will be beginning raw material inventory plus purchase of raw material plus the freight in, that equals the materials available for use. It's pretty straightforward, similar to the calculation of cost of goods sold, but now it's not for selling. It's something you're using for making. So we call that as a material available for use, and then you take away the ending raw materials, that it becomes your direct materials used. So very similar formula as we have used for calculating cost. A little bit more on this one. When we talk about cost of goods sold, it's for the sales, and when we talk about material use, it's for manufacturing or for making. So we have similar items, but they're named differently. But we're using very similar ways to calculate the same concept. Use a beginning balance plus the purchase plus the freight and minus ending inventory. So if it's for sales, it becomes cost of goods sold. If it's manufacturing, it's the direct materials used. Okay. There's an example here, so I'm not going to do this. It's on the book, so you need to do a reading of by yourself. Cost of goods manufactured calculation. So we have to talk about material use. So we need to calculate cost of goods manufactured. So it'll be beginning work in process inventory. Actually, we're going to go through this in the later chapters. Work in process, something it's not raw material, but it's also not finished products in between. So beginning work in process inventory plus direct material used. So we have used all these materials. At the beginning, we have certain work in process inventory, and plus direct labor. We have to pay for the salaries who work on the production line, and manufacturing overhead will be added to as a cost, and it'll be a total manufacturing cost to account for. So you're going to use the ending working process inventory to take it off, and then go get the cost of goods manufactured. Again, we're using very similar idea to calculate the cost of goods sold, or cost of manufactured, but we're looking at the cost that can be associated to what's either directly or indirectly associated to make this final products happen. So beginning inventory, this one actually it's for the merchandising. Beginning inventory plus net purchases equals to cost of goods sold plus any inventory. If you use move the cost of goods sold to this side, it will be beginning inventory plus net sales. Sorry, but any inventory moves here. Minus any inventory becomes cost of goods sold. Of course, net purchases, including purchases plus the duties and the tariffs plus the freighting, and actually in different accounting, you may have the other things add to this take away from the net purchases. For example, returns and discounts and so on. Okay. Cost of goods sold calculation for the manufacturers. Beginning finished goods is not inventory. It's not purchase inventory. It's finished goods inventory plus cost of goods manufactured equals to cost of goods available for sale. So basically, to calculate how much total cost we have. So we have a total cost of manufacture, but at the beginning we have certain goods in the inventory. So that's the total we have for sale. And you can do minus ending finished goods inventory. It becomes something has been shipped out. So it's cost of goods sold. So we're going to skip this one and the calculation here. Income statement for the manufacturers is quite simple. It's a sales minus cost of goods sold equals gross profit minus operating expenses equals to operating income. So pretty much the same thing, right? But the cost of goods sold will be calculated differently because it's not same as the merchandisers. It's not purchases, it's manufacturing. You have other labor costs and administrative costs and so on add to this. So here is the summary of the product and material costs. So you basically are going to do some readings by yourself. So I'm not going to spend too much time on this. Let's go on to the next. Okay, here are the comparison. Are the ones we want to look at. How do we do the calculations of T accounts? Type of T accounts. Actually, it's not T accounts. So on the left side, you're going to we're not going to really use debit or credit in this one. Beginning inventory plus the purchase the freights and minus material used work in process and equals to any inventory. So this is for the raw materials. Work in process inventory will be beginning inventory plus material used for raw materials plus direct materials labors and plus manufacturing overhead, and then you take off the cost of goods manufactured and sent to finished goods, and we get any inventory. So quite simple, should be. But if you find this a little bit too much information, don't worry. Just know what we have in here because we're going to talk about this a lot more in the future chapters. Finished goods inventory, and so same idea. Beginning inventory plus cost of goods manufactured minus cost of goods sold equals to any inventory. So, and it always can move it around. So beginning inventory plus cost of goods sold by minus any inventory equals to cost of goods sold. So you can move things back and forth from left to right, and so for this one is beginning inventory equals plus cost of goods sold equals to cost of goods sold plus any inventory. So and you move either cost of goods sold into this side, becomes inventory. Any inventory can be calculated using this 2 minus this 1, or you can use this 2 minus this 1. It becomes cost of goods sold. So the differences in balance sheet type of different for the different type of companies. Service company, they do not have an inventory account. Merchandisers, they have a merchandising account, inventory, and manufacturer have 3 inventory accounts: raw materials, work in process, and finished goods inventory. So the next objective is describe costs that are relevant and irrelevant for decision making. There are some controllable costs and uncontrollable costs. Management can influence or change costs, or something management cannot have change or control on. So those are 2 types of costs. Something like controllable costs, and they may have say, all right, we're going to hire less people, so on. But some uncontrollable costs and cannot control a change in first costs in the short run. For example, the housing of the manufacturing facilities, and the machinery costs, and so you cannot have any influence on those in the short run. Of course, in the long run, you can sell those, you can buy more, but in the short run, you don't have any way to control. So those are 2 different types of costs: controllable and uncontrollable. The relevant and irrelevant. Relevant costs are differential costs, which are costs that differ between alternatives. Irrelevant ones are costs that do not differ between alternatives or sunk costs. So that means some costs will be, no matter what, it exists. It's when it happens, it's there. So for example, sunk costs incurred in the past cannot be changed. Something cannot change is irrelevant. Relevant, you can say, okay, there's some alternatives, and if we do this, it's going to cost less, or if it's going to cost more. So do we take this? For example, products of the high, you're making things, and for schools, for example, one school maybe they based on that weight. So per pound, maybe $20, maybe $15. Which one do we use? I say, oh, I'm going to use $15, but $20 is rust proof, stainless steels, and then they have special treatment. $15 ones or even $5 ones, they may rust. So which one do we use? And so it'll be pretty big in the cost. In here is $5 and $20. So companies to make decisions on whether you're going to use either ones. Those are the decisions to be made. And the next one will be objective 7. Classify costs as fixed and variable costs. Okay, these are very important ones, fixed and variable costs. And we're going to spend several chapters talking about the fixed and variable costs, and calculate total and average cost at different volumes. And variable costs, changes in total cost in direct proportion to changes in volume. So the higher the volume, the lower cost, or the higher the cost, it depends. And mostly it's lower the cost. And a fixed cost, something stay constant in the total cost over a wide range of a variety of activity levels. And for example, again, the manufacturing equipments. So you're making full capacity, you're using full capacity or half capacity, and your cost for depreciation will be not changed, so it'll be constant. So those will be the fixed costs. Variable costs something will change. For example, we are hiring salaried or hiring waged employees will be different. We hire more, hire less will be different, because, for example, McDonald's, so they hire more people when it's in hot season, and a lot of what, for example, when you come back to school, and in Turlock, and then there'll be more demand in the food. So because we have more students coming back. Stan State is a small university, but there are large universities. So where I come from, we had over about 40,000 students on different campuses, and so the city we're in basically is college town. So when students left, the town is very quiet. All students come back. It's very and it's not crowded, but a lot of people, and a lot of people have to eat, so they're going to have to hire more people to make sales, so variable costs will be higher at that time. And also, but when people are leaving, in during the summer, and a lot less students, and so McDonald's or other restaurants are going to hire less people, so those will be variable costs. But the restaurants over there, the house, whatever it is, and you're going to pay for the same rent, so this will be fixed costs. So total variable cost here is a commission. Total sales commission is based on the total sales. The more sales made, the higher the costs. Okay, and so it's a 5% sales commission. So it's on a straight line, but not necessarily straight line for variable costs, and it would be a curve lines. And a fixed cost here is a stay constant. Which one is the total sales salaries? So sales salaries without talking about commissions, and salaries will stay the same. Okay, if you do not hire more people, it'll be the same. So total cost equals to fixed cost plus variable cost per unit times number of units sold or units made. Examples: fixed cost $20,000, variable cost per unit $50 per unit, and the number of units of 100 is 5,000 plus 20,000, $25,000 can be calculated here. Okay, the average cost is easy. Total cost divided by number of units equals to average cost. And example will be $25,000 divided by 100 will be $250 per unit cost can be calculated. The average cost per unit is not a property for predicting total cost at different levels of our output. And something we are going to introduce later is the economy of scales. So when we do calculation, total cost including the variable costs and fixed costs, and and then when you use this total cost divided by number of costs, and in fact the larger the number, and the total the average number for the fixed cost is going to be thinner and thinner. So when it gets to, and basically the more you make, the less the average cost will be. So there will be a certain optimal point that will be the lowest cost you can have per unit. That's called the economy of scales. When it goes over a certain point, actually the average price may go up. So that's why it says it's not appropriate for predicting total cost at different levels of output, because average cost may change. The trend may change from from going down to going up. So it all depends on the scales of the total products that have been made. So average cost, but in general, average cost will be total cost divided by the number of units. So marginal cost, that's cost of making one more unit. Okay, it's quite interesting. It's more in the economics. When we talk about the marginal cost, it's in economics class, talking about this marginal cost more often. And marginal costs are also used in it to use in the calculation of economics of scales, economics of scales. So marginal cost is so how much does it cost to make one more unit? And in most cases, it's going to go down and down. I'll give you an example here. Suppose you're making some say bicycle, and so to make bicycle, you need to buy some equipment. So, for example, you pay you rent it. You pay $2,000 for the rental of the equipment, plus $1,000 for the place you rent. So $3,000, and then it's made by you. So you're going to ignore your labor costs, and by utilities say $100. So if you $3,100 plus the material purchase, say it's another $100 material purchase, and then basically $3,200, and you're going to make one bicycle. So the total cost of your average cost of your bicycle will be $3,200. Or if you want to, you have zero and you want to make one more bicycle, so marginal cost will be $33,000. Let's make it $32,000. And then now if you want to make one more bicycle, let's assume you have all the materials, raw materials already in there. You can put together, and one more here. You're not going to increase any other costs. So incremental cost for this one more bicycle will be basically 32, and now it be 0. Why? Because you're not going to increase any cost to that. Or you can say, okay, I just need to increase more into the as material. So basic idea is, okay, $32,000 total, we can make 2. Okay, so incremental, you either say it's 0 or you can say it's a 16,000. So first one is 32. Second one becomes $16,000, $1,600, and so on. So the more you make, and even though you have to put in more raw materials, you suddenly find you are going to spend less and less and less per bike you're making. So when it gets to a certain point, you find you have to an optimal point, you can make bicycle that's very, very cheap to make, and it can make the best profit when you sell those. So you want to make up to a certain point. For example, in the car manufacturing, and they want to increase, because car manufacturing is very expensive for all this equipment and these buildings and the technology they have. And so the economy of scales for making cars is 300,000 units. So if you're making below this, it's not very economic to have this manufacturing facility. So these are the marginal costs. Okay, so basically this is the end of the chapter 2, and it's a bit long. It's about an hour. So if you have any questions, don't feel hesitate to ask me. I'm available to help you during this period. All right.